Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Exhibit C. I guess sound like a broken record for the last couple of Wednesdays, but oil's still $60, and the sanctions on the Russian companies apparently don't make too much difference. What does make a difference is that the OPEC Plus countries, which of course include Russia, have decided to not bring much production on. They made a decision to not bring any more production on for the first quarter of next year. I think they were talking about December production. They're only bringing on 37,000 barrels or some for a while. Well, they're bringing on like 300,000 or 400,000 barrels. So that may be enough to hold oil at $60. And $60 may be enough to curtail supplies. As I cover each Wednesday, the curve is flattening. So the curve now is in backwardation, it's not backwardation anymore. Backwardation is when the future price is lower than the current price. We're not in contango yet, but if you look at the bottom of Exhibit B, last Thursday, the 10-year month was 60 and the 26 price is 59. Gas is better. The 26 price is kind of hanging in there at $4. On Exhibit A, having the government shut down is not good for anyone, but I think lower spending will result, our deficit will be less. Getting the deficit from $1.9 trillion down to $1.5 trillion, it really needs to go down to $1.1 trillion or so before debt as a percentage of GNP starts to decline. But that would be terrific. And that would be happening in a time where China, including all its provinces and whatnot, is increasing its debt. Japan is increasing its debt. Europe is increasing its debt. So the dollar, which has been kind of on the weak side, which start to look relatively strong. With that, we have our 10-minute episode this week is a continuation of blockchain. Jason doesn't believe blockchain is going to make that much of a difference. Mike and I are urging him to be more outspoken on that subject. Though, remember we started this train of thought looking at the payments companies, and I suppose blockchain, if it really works for payments, we were talking about page 7, MasterCard, Visa, PayPal, really works for payments, it would be a bit of a threat. But Jason thinks it's been around for a while and it isn't really working in payments. So that introduction, over to Jason.
Yeah. So last week was really the history of blockchain, and this week I'll discuss stablecoins, because I don't think Bitcoin and the blockchain are a threat to Visa and MasterCard or PayPal that we have in the memo, but it could be a threat to the payment rails that a lot of the banks, all the banks operate on. And I tried to keep my opinion out of it last week, but Mike wasn't happy about that. So stable coins are pegged to a currency, and it's almost always the dollar. The largest of these is Tether. And at any point in time, there's about $180 billion worth of Tether circulating. So in order to maintain that value and the one-to-one peg, Tether and the other stable coins are all backed by short-term US treasuries. And you can kind of think of a stable coin as a dollar on the blockchain. So the blockchain is really a database technology. It's a way of storing transactions. It's beneficial by being always on and decentralized. So decentralized means that the servers processing these transactions are not owned by any one bank or any one participant in the network. It's owned by all participants. The blockchain kind of itself is trustless and permissionless, and that has appeal to consumers because anyone can join the network and process money, and what's transferred to you is yours. So you can look at that as really great at preventing fraud, but also a great place to commit fraud because transactions can't be rolled back. There's none of that. The typical services that a bank would offer. So in essence, we're talking about dollars being traded on the blockchain. You can't mint the coins out of thin air like a lot of the other kind of meme coins that pop up are. These are coins that they have to be backed by a US Treasury. So there is.
Well, recently, I mean, these were completely unregulated at one point, and now there's a little bit more regulatory scrutiny.
Yeah, previously the companies, and these are operated by companies, they said they were backed by US Treasuries, but only at, I think they were 70, 80% of the reserves were backed by Treasuries, and you didn't really know what else was doing it or backing it. So the Genius Act was passed, and it mandated a couple things, and the US Treasury backing, if it's a dollar denominated one, is one of those. It also stipulates that you can't pay interest on it. So stablecoins are really a tool meant to process transactions. It may be more so aligned with the original ideas of Bitcoin. It's not a way to store value, and it definitely it doesn't appreciate. It's pegged to the dollar. There's no interest on it. It's not where you're going to keep your money. So it's purely for transacting. Why is it appealing? Despite the blockchain being a rather slow technology, and I'll talk about that later, but it's much faster than a bank today. So if you want to transfer money through a bank, it might take an overnight processing. It might take 3 business days. You have to perform your transaction during business hours. There's no real reason a bank can't operate 24/7. They just choose not to. This allows those transactions to happen at any time. I guess do you want to give a real world use case with SpaceX?
Yeah, I think SpaceX was the first company that we had heard of that was heavily utilizing stablecoins for cross-currency or cross-border remuneration, maybe would be the right word, because they collect revenues in countries all over the world and they need to land that revenue back in US dollars. Stablecoins become a very good use case for that because you'll collect that payment in Uganda, South Africa, Turkey, wherever, want to convert it back to dollars. So rather than getting clogged up in the cycles of a banking system, which again is different in every country, they've built themselves the ability to be able to send these payments back to home base, if you will. That's frees up working capital. It saves them a significant amount of money. And so that was the first instance that I had heard of where it was being used pretty heavily. And that was a couple of years ago, I think.
Yeah. And the case I heard was they can pretty shortly after accepting the payment for a Starlink, they can move it into a stable coin and not have the FX risk anymore. And like you said, they can more frequently ship the money back to the US.
Right. And the move is not to leave it in Tether. The move is to put it back into US Treasuries for your working capital needs.
Yeah. So the stablecoins have gained a lot of popularity for this reason. And it's much larger than I had thought originally. JP Morgan estimates that in last year, $28 trillion in transactions were processed using this technology globally. So that's a much larger volume than Visa processes. But again, this isn't consumer transactions. These are larger business transfers. And as of today, I think I saw that 10 of the major banks between US and Europe are adopting plans for stablecoins, including like Goldman, UBS, B of A, and JP Morgan. In JP Morgan's case, they offer the JPMD is what their coin's called, specifically to institutional clients, allowing them to have 24/7 settlement. Overall, the two largest providers of stablecoins are Tether and Circle, which operates USDC. I think USDC is about half the size of Tether. Tether is really the largest. PayPal just launched one earlier this year. It's pretty small. It's just starting to take off. And besides dollar pegged, there's a couple smaller ones in other currencies. One of them's the Russian ruble, but the only other ones that kind of have any popularity seem like they're gold backed. So why am I not a fan of blockchain technology? I really view this ultimately as it's a place to store transactions, makes it a database, and really it's a pretty crappy one. If you're wanting to process a lot of transactions, it's very slow on the scale of the internet. Like it could not replace Visa. And the reason it's being used in the way it is being used is because it can't handle the transaction volume of Visa. It might handle more dollar volume, but less transaction volume. Blocks on the blockchain are processed every 10 minutes. No one's going to wait at Starbucks for their transaction to process for up to 10 minutes. One of the benefit, one of the selling points of this is it's a distributed network, but when the transaction on a block is processed, it has to be distributed back out to 24,000 nodes in the network. So highly inefficient. And on inefficiency, this burns a tremendous amount of energy. You have thousands of these high power computers now processing these transactions, kind of fighting to process blocks, and it's just burning a lot of energy, which is unnecessary. What we're seeing now is Circle announced that they're going to start looking at plans to allow rolling back transactions. That's something that doesn't happen natively on the blockchain. And a lot of the other banks are going to have that technology too, built into how they're processing transactions. So I think the banks are looking at it as they're going to operate the blockchain network themselves, kind of walled off from the larger blockchain, and they're going to run it on their equipment. And that's probably due to regulatory concerns as well. So what we're seeing is they're adding features that kind of converge it back towards more traditional computing. They want to make it more efficient. They don't want to run thousands and thousands of servers to process any individual transaction.
At the same time, they don't want to cannibalize their existing business, which is really nice, sitting on top of everybody's cash and making interest on it. So
Right. But I think the world's moving that way. So I think what everyone likes about stablecoins is the features it provides and not necessarily how it provides those features. So I think the future is going to be banks adopt those features within their internal systems.
programmability.
Yeah.
Those
24/7 instant settlement.
Yeah.
So I think in the end, we like the features. The features will be built. They won't be built on blockchain.
But the early history of Tether was pretty gamey, right? Weren't they continuing being dropped by their auditors? Or didn't they have some percentage of their assets in things that are, a lot more volatile than U.S. Treasuries?
Absolutely. Yeah, I think Tether started in 2014, so it's been around quite a while, but for a good portion of the early history, they claim they were fully backed by, stable assets and treasuries, but I think they were not opening their books up to even their auditors. So they couldn't perform a real audit against their books. So, and it lost the dollar peg numerous times.
Right.
But the Genius Act kind of legislates that they have to operate. It legitimized everything, and it's a viable system today.
Right. Good. Well, that's good. And we're, for the first time that I can recall, on a Wednesday, we're ahead of schedule. I guess because we're ahead of schedule, rather than do healthcare first, we can focus in on page one, the tech companies, and talk about newsworthy events for the week. We had the Amazon, Alphabet, Microsoft results, but they're all pretty strong for the third quarter. Meta, which is over on page 4, got a lot of criticism for spending. I guess both the capital spending and the operating spending, and they have the disadvantage of not having a third-party cloud business, which Microsoft has, Amazon has, and Google has. So the thinking is here, Mark Zuckerberg goes against, kind of following his own vision of what the future might look like rather than being sensible. Is that overstated the case, Mike?
No, I think that's right. I mean, Zuckerberg has been very willing to spend well ahead of where maybe the market is. He's been very clear that he believes that whoever gets to artificial general intelligence first is going to have a huge advantage. Historically, he's done a very good job with deploying capital, and the returns on those capital investments have been very, very good. So on one sense, investors maybe should trust him a little bit. In another sense, this is very far ahead of revenues in a lot of cases. So I think it's, in some senses, it's very reasonable for investors to be upset about it. And the pullback in the stock was, not that big in the grand scheme of things. So, but then you look at the other hyperscalers, the CapEx forecasts for them are all gigantic, and they all say they're booked as far as the eye can see, and they're making money as soon as they put these things in service, and they're making money on chips that have been in service for 5 years. The other thing that kind of rang through is that both Amazon and Microsoft said that they were power constrained. Like that was actually one of their key limiting factors. So that sort of explains some of these neo cloud deals that they're doing, but also we know they have large data center projects. We know that it takes a long time to get power to those data centers. So that potentially could be a bottleneck at some point.
Right. One of the interesting phenomena here, if you look at page 1, is that, Tesla trades for over 200 times free cash flow, but Apple's in their, about a 3% free cash yield, around 35 times free cash flow, mostly because their CapEx is $12 billion, where now these are June 30 numbers, but Amazon's 90, Alphabet's 65, Microsoft is 65, and all those numbers, when we post the September 30 numbers, will be higher. They're all predicting more CapEx in 26. That increases or reduces the free cash yield for Amazon, Alphabet, Microsoft down to it's the 1.5% range rather than the 3% range, or put another way, 65 times free cash flow rather than 30 or 35 times free cash flow. Jason, do you and Mike, how do you deal with this from a valuation point of view? To me, it isn't necessarily the case that Apple is cheap relative to the others. It's just their particular spot in the tech business just doesn't require the same amount of CapEx. How do you deal with that in terms of relative valuation?
Well, CapEx is generally, you have to distinguish between what is CapEx required to sustain the business that you have today and what CapEx is being invested to increase cash flows in the future. And the reason this is challenging for investors is that the numbers have just gotten so big, and there's a point where you start to question whether this is all sensible. But the basis for making these investments in GPUs that depreciate over a 5-year period is that they are making money above their cost of capital today. So unless that were to change, it would be irrational for any of these companies not to invest as much as they can in this equipment, because there is more demand than there is supply. So when you look at Apple, where they're only spending $12 billion on CapEx, look at Amazon spending 90. I mean, they could probably cut that in half or even less just to sustain the operation they have today. And a lot more cash flow would be flowing to the bottom line.
Right.
But to get comfortable with that, you have to be comfortable with these companies and the capital allocation process that they're running.
Right. And then if you turn the page to the software page, Salesforce, ServiceNow, Snowflake, Broadcom, all very low CapEx. Oracle was, is kind of number 4 in the cloud business, committing to OpenAI and running lots of CapEx, running their free cash flow to negative. So maybe it doesn't really belong on the software page, but what I and Jason are much more experienced than these software companies, but when you say, well, these are better businesses because they have lower CapEx, then I look across at the sales expense line and the R&D line, and I mean, just to take Salesforce, which is, a very successful company, part of the Dow Jones 30, which I was kind of surprised by. $12.5 billion for sales. I mean, some amount of that has to be maintaining, not increasing their sales revenue, and maybe some of their R&D at $5.3 billion. So while they look capital light, you are spending that money, some of which has to be to, as Mike says, maintain the business rather than grow the business. Is that unfair, Jason, do you think, of these software companies?
No, I think that's exactly right. When you guys were just speaking about the CapEx spend at the cloud providers, I was making the analogy in my mind that these software providers are doing the same thing with sales and marketing. They have to spend it. The thought was one day, the promise of the SaaS businesses, one day you could ramp down your sales and marketing budget and maintain your clients and you're hugely profitable. That didn't really materialize in the SaaS businesses. And maybe the same thought process goes with the cloud providers. But if the lifespan of these GPUs is not as long as they're anticipating, which today it does appear that it is, but if it's not, then they're going to constantly be having to refresh the GPUs at a huge expense.
Yep. I'll tell you what I think is going to happen here. And all these Salesforce, ServiceNow, Snowflake, and Broadcom in particular, at least for their software businesses for Broadcom, but the other three for sure, if they do a good job with implementing AI into their products. Remember, these are, in the case of Salesforce and ServiceNow, they're systems of record. But if they are going to not get disrupted by an AI first product, they will need to incorporate AI into their product, which means their cost of goods sold, their operating costs will have to go up. And some of that revenue will have to go to Anthropic and OpenAI or something else. So the gross margins are going to go down. And I bet you that they will get that money from their sales and marketing line.
Yeah. I think the hope is that, say in ServiceNow's case, that the software, the AI-powered software is good enough where it can replace the function of maybe a frontline IT worker. So they're going to capture some amount of value that was paid to that worker. So we'll see if that happens.
So you need to grow revenue faster than the gross margins decline.
Yeah. Now here's a remarkable thing, and we'll get to healthcare at the end, but here's a remarkable, if you slide above across page one, in terms of equity values, Apple at $4 trillion, Amazon at $2.5, Alphabet at 3.4, Microsoft at 3.8. And then you go down to the next line, or the next group of lines in revenue, 400 billion in Apple, 670 billion in Amazon, 370 in Alphabet, 280. And they're all trading at 50 times free cash flow because the CapEx is up pretty high. Apple with lower CapEx is around 30 times free cash flow. The king of the hill now in terms of market value is Nvidia. Now, granted, this is June 30 results, not trailing 12 months, but the rate of sales at their last income, which wasn't June 30, actually it was sitting at 1 month later, 4.9, almost 5 trillion. You've all seen the headline that Nvidia is the first to get to 5 trillion, 170 billion in revenue. But then look at the CapEx. The CapEx is only 4. The sales budget, I'm not quite sure what, SG&A, 5 billion, R&D, 15 billion. So out of 175, even after income tax, half of that comes down to free cash flow. Just remarkable statistic. So maybe that's, even though the sales are half of everyone else, maybe the valuation was kind of $2 trillion more than the average of Apple and Amazon and Google and Microsoft. Maybe it's more. It's really spectacular from a financial point of view, just a spectacular performance. And then the question is, where is the risk? Where is the competition? And it's probably not AMD or Intel. Probably got the competition has something to do with Google and Amazon having their own substitutes for GPUs, but still kind of a remarkable performance by Nvidia. Any comment before we go on to healthcare, Mike, Jason?
No, I think that's right. I think Google is the biggest threat to Nvidia, and Amazon being an emergent threat. Basically, if those other companies can provide more vertically integrated solutions that act similarly in that they keep their customers on the same platform, it will require them investing very heavily to innovate with their chips in order to keep the cost down over the long run. So we'll see where that goes. But yeah, Nvidia's architected a pretty phenomenal business model for itself.
And the only company that generates more free cash flow is Apple, and that probably won't last very long.
Yeah.
That being number 2 won't last though.
Yeah. They'll blow like Jason, and even though he did buy a new iPhone, he's always kind of a shade bearish on Apple.
I like the new software, but now its shine is worn off.
Yeah. Healthcare news, Jason.
I guess I'll try to be quick. Novartis made a big acquisition of Avidity Bio. That's here in San Diego. We're starting to see more M&A deals, which is great for the industry. We kind of thought that this would start happening by now because Big Pharma has their a lot of patent cliffs coming in the next year. They need to replace that revenue. So these acquisitions are a way to replace that revenue. It gives the founders and scientists at the acquired company liquidity, and hopefully that starts beginning to roll back into early stage biotechs and the research. So that would be great for the industry. More evidence of direct to patient platforms gaining momentum. Eli Lilly said that 1/3 of their Mounjaro sales are being processed through Lilly Direct. And then rumors are right now is that there's a deal with the White House where Lilly's weight loss drugs will be provided for, I believe, $149 a month direct to patients. That we wrote an essay about how it could improve healthcare costs. There's a lot of research being done right now of all the benefits of these GLP-1 drugs on other parts of the body, that not just losing weight. If someone opts into taking this and becomes healthier and they have less inflammation and all this other benefits, I guess the real goal is that there's much less demand for the resources in the healthcare space and kind of drives down utilization. So,
and in your analysis, in that what you wrote up, I believe you said that it would cost about $150 a month. If the government was able to spend about $150 a month, that would be a worthwhile investment.
Right.
Yeah. So,
yeah. Because the savings will come back to the nation as a whole. Other less rosy news at the FDA, George Tidmarsh resigned. He had a personal kind of scandal, a conflict with a prior colleague that had a conflict of interest in his role. He was kind of the traditional insider pick for running the division that handles pharmaceutical approvals. He was going to be the rational mind at the FDA. So it's unfortunate that this happened. Another thing that happened at the FDA, another situation, was they rolled back their signaling on the Huntington's disease treatment that Unicure released data on. It was pretty dramatic, the efficacy of their drug on this disease. And counter to what the director has been saying of trying to get these treatments out faster, they signaled to Unicure that they're not able to accept an accelerated application for approval. So that that's kind of disappointing to see it go back the other way. Vertex had earnings. So just real quick on that, CF is powering along, generating a ton of cash flow. The Jernavix launch has been a little underwhelming. Could be likely due to pricing or the No Pain Act not being listed on the No Pain Act list, or both. It costs about $31 a day for this pain treatment versus $1 or $2 for a generic opioid. They do have wider coverage on PBMs now today, but my hunch is that they're not covered by the No Pain Act, which allows the government to subsidize a non-opioid pain treatment. So my feeling is that the PBMs are kind of waiting that out, and they'll want to have the payment reimbursed by the government and then also receive a kickback from Vertex for prescribing it. So that's a hunch though.
But the reason that's not out, we think, is because of the shutdown.
Right. The October 31st was supposed to be when they released the updated list. Obviously, the government's been shut down for a month. That didn't happen. They are seeing adoption in the plastic surgery field. So elective surgeries, you're paying for the pain treatment yourself out of pocket. The physicians that have adopted it were prescribing 90% of the case study that they provided. 90% were being prescribed opioids. Those physicians have flipped it to only 10% of their population or their patients are receiving opioids at this point. So it seems like it's effective for that kind of mid-grade pain. And it has a quick uptake, at least in one vertical.
And next week for our 10-minute thing, I think we agreed we do Taiwan Semiconductor, but also pay some attention to this startup that's gotten some press about a completely different way to make the chips that would obsolete lithography and so on and so forth. Is that still on for next week?
Yeah, let's do that.
Yeah.
Okay, Doc. In the meantime, everyone be well and stay healthy, and we will remember to get the Harrows earlier next week. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.